afternoon and welcome to Capital Account. I'm Lauren Lister here in Washington, D.C. These are your headlines on this Tuesday, August 14th, 2012. Let's go back in time. Remember the threats reported about what would happen if Wall Street wasn't bailed out?
The market would drop 2,000 or 3,000 points the first day, another couple thousand the second day. And a few members were even told that there would be martial law in America if we voted no.
That was years ago, but it's hard to forget as the legacy is still with us. Too big to fail banks standing to take down the economy while taxpayers are expected to shoulder the losses. Banks rack up a higher than expected tab, as with the auto bailouts, well, that's car companies really, while getting a slap on the hand for messing up. I could go on, but we'll talk about all of this with former TARP cop Neil Barofsky, who's out with a new book, Bailout. And while we're on it, Bloomberg reports Russell Wassendorf Sr., the CEO of the bankrupt firm Peregrine Financial Group, was indicted on 31 counts of making false statements to regulators. We'll ask Neil Barofsky if sans suicide note confession, there are legitimate criminal cases that could be built around executives at major firms, too big to fail firms, surrounding the financial crisis and its aftermath. And I should mention for our futures and commodity trading viewers, Barofsky prosecuted the CEO and president of Refco. So real hooker there. And finally, since we're talking being locked up, we'll tell you about the Apple of the U.S. prison systems. Turns out they found a captive audience. Let's get to today's Capital Account. All right, it's been a few years, but I tell you, on any given day, we can see the legacy of the financial crisis and its response from the government in the news. It is a legacy taxpayers are still footing the bill for, while Wall Street seems to be paying less for its crimes. And that is to put it lightly. Today, for example, the SEC charged Wells Fargo's brokerage firm, as well as a former VP, for selling investments tied to mortgage-backed securities without fully understanding their complexity or disclosing the risk to investors. That's according to a statement from regulators, and Wells Fargo agreed to settle the charges. Now, we're glad there was something done, okay, better than nothing. But a fine of $6.5 million, no admission of guilt or denial, for that matter, and a 6-month suspension of the VP from securities from that industry sounds like a hand slap and a broken record, too. Meanwhile, yesterday we found out from the U.S. Treasury Department the auto industry bailout will cost taxpayers $3.4 billion more than previously thought. Treasury now believes this bailout will cost Uncle Sam just over $25 billion. That's according to Reuters. And this is not including the costs associated with the failed and false promises tied to hundreds of billions of dollars of taxpayer bailouts doled out through TARP to financial institutions under false pretenses of what that cash could do and what it was supposed to do. That's according to the man who was policing it, touted, of course, the programs I'm talking about, to the taxpayer with platitudes like this.
What's really innovative about this is partnering with private investors, partnering with the FDIC and the Federal Reserve to get all the resources we can to get those things off banks' balance sheets.
That was referring to a particular program that I'm very excited to ask our guest about. The man I was talking about, critical of TARP, the way it was dealt with at least, is Neil Barofsky, the former Special Inspector General for TARP, and he's author of a fantastic new book. He doesn't mince his words, I have to say. It's Bailout, an inside account of how Washington abandoned Main Street while rescuing Wall Street. And Neil Barofsky first, as I said right before we started, boy, am I excited to have you to talk about this book. I was telling you, it is very refreshing to see fraud uttered more in one page of this book than I've heard on the Hill or by Wall Street execs for a very long time. It seems to be the F word in Washington, at least, and probably in New York, too.
Well, yes, it's probably right. It is one of the frustrations of the recent financial crisis has been the lack of accountability for a lot of the acts, and not just the criminal acts, but also acts with civil liability, and the lack of accountability on behalf of the regulators who've so fallen short in their jobs.
And I would agree with all of that. So I really want to dive right into a part of your book that we found really fascinating, and that's why I chose the soundbite I played in my intro, because it was a TARP program called PPIP, Public-Private Investment Program. Sounds innocent, but as you say, it was designed by Wall Street for Wall Street. And what I found so, I guess, creative about this was that for a financial crisis built on leverage, that the so-called solution, which was TARP, that Wall Street and/or policymakers found a way to use leverage with the programs that were supposed to solve the problem of too much leverage. So I guess it's no shocker you say it was designed by Wall Street, but could you explain that assessment and why that happened and what impact it had?
Well, this was a program that was announced by Secretary Tim Geithner, Secretary of the Treasury, in February '09. And, at the time, I was, of course, responsible for providing oversight of the bailout. And we sort of knew something was coming. We heard some of the details. But as we kept pressing within Treasury to get some actual mechanics and details, they kept putting us off until those details emerged. And it turned out it was originally intended to be a $1 trillion program that was so riddled with opportunities and advantages for the giant investment funds, the Wall Street funds that were going to run the program, that it was primarily based on lending tremendous amounts of taxpayer money, leveraged through multiple different government bailout programs that could have left it to be less than 1 or 2% of actual investor money. The rest of it all provided by the taxpayer with a very limited upside, but all of the downside. And there were so many conflicts of interest and opportunities for fraud built into this program that ultimately we had to object to it in its entirety. The one good news I do get to report in the book, as far as we were able to really blunt the impact of this, although Treasury would not listen to our complaints, Congress did, and eventually even the Federal Reserve, who is part and parcel of this program, refused to go along with some of the more insane things that Treasury was pushing, and were able to stop that money from going out.
And I want to get into a lot of the themes that you just mentioned there that go through your book about the Fed and the Treasury and some of their tactics and underhanded tactics. But first, one of the things that really struck me with your description of this program and what Treasury was pushing for various agencies was that this program was for select firms, for chosen firms that would work in partnership with the government. And there was potential for the chosen fund managers, for example, to use this program to move markets that could then boost profits for these managers' existing books. And I'm pretty sure, I'm guessing that if you're a retail investor, you couldn't line up to get in on the action with a program like this. I'm curious what you think this embodies as far as crony capitalism here in the U.S. in your view.
This was really an example of it at its worst. At the time when we were still dealing with the program, we couldn't really understand why Treasury was sticking to a program that gave such opportunities, because it literally gave these very small handful of hand-picked investment managers $1 trillion worth of buying power to move markets in bonds that had been frozen. The market had been frozen, so the prices were very susceptible to big swings. And the whole point of this program was to drive up prices to a certain extent so that these managers could have insane profits in other parts of their business, potentially at the expense of the taxpayer if they were to artificially boost up these prices, either directly or colluding with one another. And it got so bad that I was complaining and working with the Federal Reserve that a lawyer at the Federal Reserve Bank of New York, I would commiserate every time I had one of these incredibly frustrating conversations with Treasury. And he said to me, it's as if their mouths are moving at Treasury, but it's actually Larry Fink, one of the CEOs of one of the big investment houses. It's like his words are coming out of their mouth. This is someone at the New York Fed who was offended by just how one-sided this was. And eventually, we ended up doing an investigation to find out how this program was designed and how these fund managers were there. And it turns out that the very managers that were going to get this huge advantage had essentially designed the program for Treasury and were vetoing my suggestions to try to protect the taxpayer from fraud.
Wow. I wanted to get into this later, but what do you think is responsible for that? You said essentially you felt like these guys at Treasury were a mouthpiece for Wall Street, and even someone at the Fed was complaining about that. That's a theme in your book, that Treasury was always trying to undermine you and trying to protect protect the interests of Wall Street in your view? For example, with executive compensation for Wall Street executives and assorted other things. With the Fed, for example, coming around more and kind of being more amenable to what you were suggesting. Why do you think that was? Why do you feel like Treasury was so in bed, and to put it that way, with Wall Street, but the Fed even wasn't to that extent?
Yeah, and I should say to that extent. I mean, the Fed is a thoroughly captured institution as well to the interests of Wall Street. It's just that Treasury had gone such off the deep end on this particular program that it offended even the Fed, and they helped put a stop to it. Look, there's a number of reasons, but what I saw over and over again, and I have to say, coming from New York as a federal prosecutor, I was shocked to see the level of control, ideological control, that the Wall Street institutions had over Treasury and the officials in the Bush administration, and then again in the Obama administration. And I think part of it is a result of the revolving door. So many of the people I were dealing with came from the same banks that, of course, helped drive us into the financial crisis. Banks like Goldman Sachs, Merrill Lynch, Bear Stearns, and they brought that Wall Street ideology with them. And even those who maybe didn't come from those banks had so surrounded themselves with these individuals that they started to adopt this way of thinking. And I heard it over and over again. Whenever I would push for an important protection, I would hear that we didn't need to worry about it, that I was sort of out of my mind because we could just trust the banks not to risk their reputations by engaging in self-interested conduct. I mean, it was as if they had ignored all the lead up to the financial crisis. But that mindset is very much there, and it's still alive and well today. And it's one of the problems with our regulatory structure is that as a result, you have these interests that are looking out not for the people they're supposed to be serving, the taxpayer, but again, serving the interests of these largest banks.
And speaking of not changing their thinking and ignoring the financial crisis that just happened, you paint a really interesting scene that stuck out to me, too, where you're talking to William Dudley at the New York Fed, and you're asking him how he's going to protect against fraud in the TARP program, another TARP program. And he says, well, we're going to trust the ratings agencies to rate the AAA-rated bonds, and we're going to trust that, and we're going to trust our economic models, and we're going to trust investors to do diligence. So in essence, all of the things that led to the financial crisis, and I don't know if he wasn't seeing that or he didn't want to see that. I don't know. Now, New York Fed came around with a lot of your recommendations on that, for example, in terms of enforcing compliance, but I'm curious, do you think that that's still the attitude with regulators at the top, that they can't see what's going wrong and correct, or they don't want to?
I mean, absolutely. They saw all the problems that led to the financial crisis, and they started designing programs that not only replicated all of the broken factors, but added as an accelerant, huge amounts of government guarantees. And when I pressed Dudley, his response was that he didn't think the rating agencies would embarrass themselves again. I mean, those were the exact words that he used. And this continues to be a major problem. This sort of presumption of goodness, of soft touch regulation, that they can trust the banks not to operate by their obvious incentives to seek profit at all costs, but out of some sort of public-minded interest. And this was characteristic of so many of the TARP programs. And it's a real problem because these institutions have such an advantage because of their incredible size and have the ability to really flout the rules that are supposed to rein them in.
Yeah, and there's so much more I want to talk to, but we're going to go to break quickly. We'll come back in 1 minute. We'll have more with Neil Barofsky, author of Bailout and former Special Inspector General, kind of a tongue twister for TARP, still ahead. The Treasury. Neil Barofsky says it was quite a barrier to him doing his job. Wasn't a fan of Timothy Geithner. We'll have Timothy Geithner's response to some of Barofsky's claims. But first, your closing market numbers.